And we are back. This is the Working Title Show with Zach Sams. It's been a couple weeks, but we are excited to be in Dallas, in Texas, the greatest real estate market in the country, and we are just here to tell the good news. You turn on the news every day, and I don't know about y'all, but I just feel I get mad. It's nothing that we want to talk about or hear about. But on this show, we want to talk about the great things that are happening in the Texas economy, the Dallas economy, the real estate economy, and bring on great guests that can tell us more about what we don't know or ways that we can improve our real estate business, or just understand better what's happening in our markets. And so we have a great guest today, and as always, Trey is in the booth with me. Hey Trey, how you doing, brother?
I'm doing good, man. I like the passion that you brought in today about getting mad about the news.
I'm passionate today, Trey. I'm full of passion. I don't know what's going on, but yeah, I'm feeling good. It must be this great weather.
Yeah, that Texas heat's bringing it out of you.
No, it's cooled down the last couple of days. It's been awesome.
Man.
Yeah, it's really, really good. So anyways, let's get right into it. We have a great guest, as I mentioned. His name is Scott Hendrix. He's a wealth manager and accredited investment fiduciary for Upstream Investment Partners. And Scott, you came all the way up from Austin to be on this show with you, and we can't thank you enough. How are you doing today?
I'm doing great, Zach. Thank you so much. We had an overnight record low for July.
We did.
In Austin last night.
Well, I hope y'all took advantage of it. I know I did. You might have heard me mention earlier that I found my way to the golf course at about 7 a.m. last night and hung out there until dark because the weather was just so nice, and we just don't get a break like that usually, do we?
It's what we call Chamber of Commerce weather.
Absolutely. So Scott, hey, why don't you give us a quick little bio on you? You're a wealth manager, you're an accredited investment fiduciary, you work for an investment firm. I know that you're helping people defer taxes, put taxes off, and that's a big part of what you're doing. But give us a little bio. How did you come into this? Where'd you come from?
Sure.
And how did you get into this business?
Appreciate it. I first of all, thank you for having me.
Absolutely.
It's been a fun day up in Dallas. I originally from Austin. About 25 years of my career was in financial work for either governments. I worked for NASA for 10 years.
Oh, wow.
Down in Houston, doing contracts and cost estimation. Went to work in Austin for private companies, mostly in the high-tech area, always doing finance. I was a treasurer for a publicly traded company, biomedical company in Austin, and I had always been doing my own investing, just kind of always enjoyed the numbers and the economics of it.
Were you investing in real estate or all sorts of things?
Mostly for corporate profits, you want to be very conservative.
Sure.
Especially when you're publicly traded. So we're talking things like cash and cash equivalents, marketable securities, bonds.
Right, okay.
Pretty conservative stuff.
Sure.
But had a real aptitude for it, I think. Did a good job, enjoyed it. But my mid-career crisis was to figure out that I didn't want to work for large organizations for the rest of my career. So
sure.
Went and got my securities license, went to work originally for one of the large national investment firms. After about 2.5 years, went to my private partnership, Upstream Investment Partners. We are in about a dozen states.
So Upstream is your own business, or you have with a partner?
I am a partner.
Okay.
In Upstream. We're a network of about 150 reps. We are in effect a co-work space for independent wealth managers. We do have a broker dealer we affiliate with.
Right.
But we all run our own practices, own our books.
Right.
My business is principally managing my clients' portfolios on a fixed percentage basis. About 4 years ago, I was approached by a friend in Austin who was due to inherit some real estate.
Okay.
And in the course of that conversation, we learned about the 1031 exchange, which many of your audience are familiar with.
We've had a show on 1031 for sure, but you can give the 50-word reminder what 1031 does.
Absolutely. It's a powerful clause in the Internal Revenue Code, Section 1031, and it allows for the tax-deferred exchange of investment real estate. So a person who owns property either for their business or as an investment, let's just keep it simple and say an apartment building, and wishes to sell it, the tax code provides that they may defer the gain on that property and not pay at that time the tax on the capital gain, that is the profit above what they originally paid.
Sure.
Or the cost basis of the property.
So they don't have to pay that now. They're deferring it, but they have some little bit of criteria in there, right?
15 to 20% taxes that would go to the IRS are deferred, allowing the investor to invest those dollars, continue to invest it in property that they will continue to own.
Sure.
There are, of course, certain rules and timelines. The investor has to line up a third party known as a qualified intermediary before they sell their property, so that the funds can transfer from the sale directly to the qualified intermediary who holds the funds as if in escrow. It's a similar role.
Right.
While a 45-day clock begins, that's the time that the investor has to identify the properties they wish to buy with the money, up to 3 properties in most cases. And they must abide by that very strict 45 calendar day deadline. Beyond that, they have 135 days to close.
Right.
So it's really 180 days from close to close. Tight timeline, must be abided by, or the deal doesn't work.
Right.
And the investor will simply have to pay the tax.
Sure.
If they wish to defer the tax, they have to complete a successful 1031 exchange, abide by those timelines. There are obviously certain other requirements and rules they have to follow, which your audience has probably heard in previous programs.
Right, and we'll also we'll connect everybody to you, so if they have further questions after hearing this podcast, they can find you. But appreciate that. So, actually, at this moment, why don't we take a quick break and we'll pick up right there where we left off. This is the Working Title Show with Zach Sams with Scott Hendrix. Thank you very much. And we are back. This is the Working Title Show with Zach Sams. Is that like Primus, Trey? Who are you playing there? Let me guess.
That is actually Victor Olsen is his name.
Victor Olsen.
Victor Olsen.
Yeah, he's very famous. I think he's playing this weekend in Dallas.
Yeah, I believe so. Maybe at Trees.
Yeah, he's really good.
Wasn't he the bad guy in the Austin Powers movie?
Ah, there you go. I knew I'd heard that name before.
You discovered his secret identity.
So welcome back, Scott. Like I said, this is the Working Title Show with Zach Sams, and he stayed through the break, and he's back. Scott Hendrix, he is the wealth manager, accredited investment fiduciary at Upstream Investment Partners. Scott, thanks again for being on.
Glad to, Zach. Thanks for having me.
You got it. You got it. So you were telling me before the break, you're in the wealth world, right? And a friend of yours inherited some property, and I guess you stepped in to kind of help him there.
A buddy I grew up with in Austin had some ranch land that he was due to inherit, but the family wanted to go ahead and sell it before the original owners passed. And so we learned that there's a way to do this and defer the tax on the capital gain under Section 1031, as we were saying earlier. And light bulb kind of went off in my head, and I thought there is so much family money, wealth, tied up in real estate that people need to know about this. And I talked to a few realtor friends of mine, and I said, hey, there's this 1031 exchange thing. Have you done these before? And they said, yeah, we have to take the continuing education for our license every year. We know about them.
Right.
But have you done one? No, they're complicated, and investors feel rushed, and I'd rather sell single family homes.
Right, and they don't want to talk about something they're not competent in.
So it just began to come together for me. I realized not only is this a way for me to develop an area, sort of a niche of specialization, and also to talk to realtors and others in the real estate professional network that can really be leveraged for the benefit of property owners.
Well, and I would think that a lot of people that, maybe that, they're not in the real estate business, but their family had real estate or they're inheriting real estate. I mean, these are not sophisticated real estate people. They're not going to know about 1031s. And they're probably, I'm sure a lot of people are paying a lot in taxes in some of these situations because they don't have the guidance to avoid or defer them.
It's commonly thought when you sell an asset that you've held for a long time, real estate asset, and it's going up in value, you're just going to have to pay the tax.
Right.
The government needs their piece. Well, 1031 was created back in the 20s. It's been around a long time. It's used extensively. It's not widely known in the sort of the retail real estate community.
Sure.
It's not widely done, I should say, because of some of these requirements and regulations.
Right.
The opportunity with and to your point, yes, in the case of long-time property owners, it's just never crossed their mind that they could sell and not pay tax at that time on the gain.
Sure.
Thinking that they're going to owe the tax bill is a hindrance to them even wanting to consider listing.
Right.
An investment
They
property
don't want to
for
pay the
sale.
taxes. Sure.
So this is where I believe, by working with realtors and working with title companies and working with others in the profession, to get the word out that
Right.
the 1031 section exists. A longtime real estate investor can sell their property and defer their capital gains tax. That
Sure.
can be a substantial amount of money
Well, absolutely. And
that the investor
also,
gets to keep and reinvest.
absolutely. And also, I mean, if you're a realtor or maybe you're a commercial broker or whatever, if your client is selling one property and then turning around, exchanging it, buying another property, now you just closed two sales where and the other side, they're just paying taxes. You're only doing one sale, and that's the business is closed at that point.
Correct.
Yeah.
So it's a rare segment of the real estate community that uses this 1031 option
Right.
with their investor clients that I believe have found a way to succeed in the same way that I have done with my practice to become known for something.
Sure.
And then you target your marketing.
Yeah.
You no longer have to run around the city putting flyers on people's windshields because you're the new realtor in town.
Right.
People come to you because you're known.
You have a niche in the market.
You can execute a 1031 exchange transaction for your clients successfully, save them
Right.
the tax burden at that time.
Yeah, and you have another point to your business that separates you from your competition.
Right.
Well, let's pivot for a second because, we were talking, before we got on the show about Delaware Statutory Trust, and this
Right.
is something new that to the point of 1031. A lot of people don't know this, and I've known about 1031 for a while because I'm the business that I'm in, right? But we were connected recently, and you told me about Delaware Statutory Trust, and this is just another. Way to put off taxes, to avoid taxes, whatever you want to say, lower your tax liability. Would you give us the and do this for my sake? Give me in the Army we called it Barney style when you explain something to a 5-year-old, like the old Barney show on Channel 13. But we'll just say in layman's terms, or so we can all understand. Kind of give us what is a Delaware Statutory Trust and how does it work?
Yeah.
Outside of a 1031 or within that space as well.
You bet. First of all, boys and girls, I will say that the name Delaware Statutory Trust is an awkward, funny name. I wish they'd come up with something a little more.
Well, it makes you think.
artful.
Well, I don't live in Delaware, right?
Right.
Yeah.
It's a legal structure, obviously set up under the statutes of the state of Delaware. It means nothing. It's like when oil tankers are all flagged Liberian.
Right.
So the Delaware Statutory Trust, the simplest way to explain it is, and I'll use the acronym DST.
Excellent.
The DST is just a trust wrapper around real estate.
Okay.
So it creates a passive real estate investment. What does that mean? It means that investors can buy a fractional interest in the trust, which is real estate. They own real estate, but they are passive investors. They are the beneficiaries
Meaning
of the
that
trust.
if I own a house and it's got a DST on it, right, and you're and you've bought into the DST, you're not on the deed, meaning that you own a piece of the house, but you own a piece of that trust that is wrapped around the real estate.
Exactly. You've become a beneficiary to Zach's house.
Right. Okay. Very interesting.
Zach owns the property. The sponsor, we'll use the term sponsor in the DST business. The sponsor owns the real estate. They are the landlord. They deal with the tenants, the repairmen, the property taxes, and the bank financing. The investor comes in passively as a beneficiary to the trust. They own equity. It's a fraction. They have equity. It's a fractional ownership, but they bear no responsibilities of a landlord, and they are shielded from liability as a borrower.
Right. So if somebody breaks their neck at the apartment building, they sue the property owner on the deed. The beneficiary inside the DST, they're not on the hook for that, except for that could hurt returns or something at one point.
That is a risk of investing, as with all investing.
Right. But they're not going to get sued for doctor bills by this person.
They do not bear legal liability. That is the responsibility of the landlord, the sponsor.
Very interesting. All right, let's take a quick break. I've got now a dozen questions, and we'll be right back. This is the Working Title Show with Zach Sams. We'll see you in a few. I know that's Primus. That has to be Primus, right?
No, it is not.
I've never gotten one of these songs right.
I don't think you're even in the ballpark, boss.
What a great podcast we got going on here. Anyways, this is the Working Title Show with Zach Sams, and Scott Hendrix is back with us. He's a wealth manager and accredited investment fiduciary from Upstream Investment Partners. Scott, again, thanks for staying around for the third segment.
You're welcome, Zach. I'm happy to be here. I got a knot on my head from banging it on the table just a minute ago, listening to that music.
Yeah, we get it done with the music in here. There's no doubt. There's no doubt. So, when we went on to break, we had an interesting exchange, I thought. And so, in a 1031, let's say I own an investment home, right? And I sell that home with the intention of doing a 1031 and buying, let's say 2 homes, right? Which is a typical scenario, yes?
Yes.
But, and the rule in 1031 is you find a like property, which basically means it needs to be real estate. But you're telling me that a DST could actually fulfill that replacement property?
Yes, it could.
So explain how that would work. Do you actually have to have a property picked at that point, or how does that play out?
You bet. A DST is real estate. As I said earlier, it is simply
it's a trust wrapper around real estate. So the important part of that is it's around real estate, not around farm equipment or something else. It's
not
only real estate.
Around stocks, bonds, and mutual funds.
Right. Okay.
It's a trust wrapper around tangible physical property.
Got it.
That is owned by a sponsor.
Right.
Who offers fractional equity shares to investors.
Right.
The unique thing about the Delaware Statutory Trust, or DST, is it is the only form of passive real estate that is 1031 exchange eligible. So if in your case you're selling your home or your rental home, remember, because we're talking investment property.
Absolutely.
Primary residences, you cannot 1031 exchange.
Exactly.
But if you're selling an investment apartment building and you want to buy 2 apartment buildings, one of them could be wrapped in a Delaware Statutory Trust if it is already, and you can become a passive investor in that second apartment building by virtue of going in as a fractional owner via a DST, while you also have purchased another apartment building in your neighborhood that you want to go be the landlord of.
Right.
So you've accomplished the sale of an investment property. You now own as a landlord another piece of real estate. Doesn't have to be another apartment building. You could go buy
it could be an office building,
a gas
anything.
station.
Sure.
But you also own another piece of real estate as a fractional owner that somebody else does all the work. They're the landlord. You receive the income from it.
Right.
It's real estate, so it is a way for you to reinvest your tax-deferred proceeds from the apartment building you sold and reinvest in the DST, real estate,
Right.
and complete the tax-deferred exchange 1031 transaction.
Does Delaware Statutory Trust always involve a 1031 as well?
Not necessarily.
Let me back up a second. So I'm selling my apartment building, right? And in a 1031, you have to identify another property, right?
Right.
Can you just set up a DST? How does the DST get set up? Do you set that up and say, I'm moving this money after the sale into the DST and not have a property yet to buy?
DSTs have to be pre-existing. They have to be created by a sponsor, and then they have to be opened up to investors. So you've got to find a DST that already exists.
Okay, so I think that's where my question is how does the DST get started? Do I start it myself as the apartment owner about to sell that apartment?
That's an option.
Okay.
A landlord, the deed owner of real estate, can create a Delaware Statutory Trust
Right.
form of ownership of the property they already owned. It changes the nature of the ownership. It doesn't change the owner. It simply changes the legal nature of the ownership.
So before you sold that, you would put the property you're about to sell, you would create a DST around that property.
That is a possible approach.
Okay. What's the typical way? How does a DST typically get started and used? And let's do it from let's say I'm going to do this. A layman, I don't own a ton of property, but I want to go in this route. How do I get started?
Yeah. USAC would probably need to go to the bank and borrow a lot of money.
Right. Let's pretend I have,
Right.
good money and I own a nice, income producing asset.
Right. So if you own a good income producing real estate asset, you would draw up Delaware Statutory Trust documents.
Okay.
And once finalized, the nature of your ownership of that property changes.
Right.
And you now are the sponsor
Of the
the
DST.
DST.
Got it.
Owns the same real estate in almost all cases. I would say 9 out of 10 or more cases. DSTs are institutional scale real estate.
Right.
These are hundreds of millions of dollars worth of real estate wrapped in a trust, sometimes multiple properties can be within the same
DST
trust.
could it have 10 apartment buildings in it?
Could.
It could have one.
Typically it has 1 to 3.
Okay.
1 to 3 in the case of apartment buildings. There are also Delaware Statutory Trusts that own self-storage units up to more than a dozen individual properties in self-storage. Medical office could own a couple of different all commercial office buildings. Industrial warehouse or industrial facilities
Interesting.
could be part of a DST, but typically we're talking institutional scale. Sponsors are usually large billion-dollar real estate investment companies.
Okay, so people that are doing DSTs are not are not individual owners and investors. Typically, they're very, very high net worth, and the properties that are inside their DSTs values are in the 9 figures.
Typically.
Okay.
But the beauty of it is that kind of real estate is now accessible to the individual investor for as minimums. Officially, there's around a ballpark $100,000 minimum.
Okay, so I'm grasping what we're doing. So most people, when it comes to a DST, they're looking for those to invest into because they're not wanting to invest in stocks and bonds anymore. It's not that, the person that owns 10 single-family homes needs to go out there and create a DST for their small portfolio.
Mostly what we see are investors who are executing a 1031 transaction and they'd like to diversify and own commercial office.
Right.
But they themselves as an investor don't have $25 million.
Right. Okay. So
they have maybe $2.5 million, and so they'll become a fractional owner by investing in a commercial $25 million commercial office building structured as a Delaware trust.
So if you're somebody that you did own those 10 properties or whatever, you had a decent portfolio, and you're just tired of doing all that. You want to sell that off, liquidate it, but you don't want to pay the capital gains, so you're going to defer that in and invest into a DST, that a large entity with hundreds of millions of dollars worth of property that know what they're doing, and you're investing in them, and you're basically turning that's now mailbox money.
Bingo.
Got it.
Yeah. The three principal ways that a DST is a powerful tool and an option, and really a way for realtors to break out from the pack and become known for something. You want to have a DST named as a backup property when you do your 1031 exchange. Remember, we talked about that 45-day window?
Yeah, when you have to select your properties, right? So you select the DST at that point.
Well, if you want to buy a piece of real estate in your neighborhood, name that within the first 45 days of your sale. You're closing on your sale to start the clock. But if that deal falls through on day 46 and you have not named a backup for your money to fall back into to successfully complete the 1031, your deal is gone, your 1031 is gone, you have a tax liability.
Yeah.
So I urge clients, and I urge realtors to urge their clients, while we're in that 45-day window, you may want to go after that property you've had your eye on for a long time, but let's name a backup, and let's just pick up a nice passive piece of a Delaware trust in medical office or self-storage or apartment buildings that we don't have any previous expertise in, so that if
So worst case scenario, you don't end up paying capital gains, and you're in a good investment.
Exactly. You still own real estate. Yes, it's passive, but you've deferred your obligation to pay capital gains tax, which could be as high as 20%. It should also be noted, as your audience has heard previously, you also have the opportunity to defer depreciation recapture tax, which is 25% of what you have depreciated during the time you've owned the property you're selling. And you may, depending on your tax bracket, you may be able to defer, if you're in a state that has a state capital gains tax, that can be deferred under Section 1031 as well. So
interesting. So it sounds like you really need some good expertise and some good counsel when you're going through one of these, and you're one of those type of people that people could reach out to. So since we're out of time, Scott, what I want to do is I want to make sure that we get your information. If anybody's listening and they want to reach out to you, what's the best way to do that? And then we'll link that to the website and to the Facebook page as well, so people can find you.
I would welcome people just to give me a call.
Okay.
I'm in Austin. My number is 512-563-2134. 512-563-2134. Give me a call. As a backup property, DSTs are great. To capture leftover cash, that is, if you're investing in a property that isn't as much as the property you're selling, you've got some leftover cash that you don't want to get taxed on, park it in a DST.
So you could buy that property and then put the remainder into a DST.
Correct.
That's
correct.
That's excellent.
And as you noted, Zach, for the investor who simply is done being a landlord and wants to go passive but doesn't want to pay the capital gains tax on what they're selling, they could roll the proceeds into a variety of DSTs, diversify, go passive, collect the mailbox money, and still own real estate.
Very interesting.
It's worth noting that DSTs are accessible only to accredited investors. These are simply investors with $1 million or above net worth outside of their primary residence, or income above $200,000 for the last 2 years, likelihood of making the same this year, or $300,000 if married filing jointly. They are limited to accredited investors. You can invest in a DST with cash. You don't have to do a 1031. So it's a great way for accredited investors to begin owning passive real estate, which they can 1031 out of.
Right. Sure.
The DST when the sponsor sells the underlying property. The shareholders are able to complete a 1031 at that time, even if they came in originally just as cash investors.
Fascinating. Scott, I really appreciate it. We are out of time. Thank you so much for being on. I hope you'll come back up and we can do this again, because I think we could go another 30 minutes easy on this conversation.
Well, it's a 3.5-hour drive, but I think it's been well worth it.
I appreciate it, Scott. Thanks so much, and we'll all see you again next time. This is the Working Title Show with Zach Sams.
You bet.
Any investment, including real estate, is speculative in nature and involves substantial risk of loss. Scott maintains a Series 7 General Securities License and a Series 66 Combined State License supervised by the Financial Industry Regulatory Authority. He is not an attorney or a CPA. We encourage our investors to invest carefully. We also encourage investors to obtain legal and/or tax advice from professionals licensed in those fields and to make independent investigations before acting on information that we publish.